Want to generate consistent income month after month with much less capital than is needed with a traditional covered call or buying 100 shares of stock outright, which can be thousands of dollars? Well, in this video, I'm going to show you step by step exactly how to place the poor man's covered call, which utilizes long-term options, and then we sell a short-term call against it and collect that monthly income month after month. It's a much lower cost way to trade and collect that monthly income and profits month after month. So whether you're a new beginning option trader or investor, we've got something for you in this video. We also, for the experienced trader, stay tuned, watch to the end. You can check the timestamps down below, but if you already know how to place the poor man's covered call, you can scroll ahead and look at the trade that I'm putting on, that I just put on this morning in utilizing the poor man's covered call. And it's a great stock to profit over the next 1 to 2 years plus and beyond. So, all right, let's get started. Before we dive in, one thing I ask, one thing only, smash that like button down below for me. It really helps out the channel to get the video out to more people. You're certainly welcome to subscribe as well. And there's a free options workshop in the link below as well. So check that out. And if you want to really level up your game and learn everything there is about option trading, there's a paid course as well. All right, guys. So what is the poor man's covered call? Fancy name, right? Well, it's got the benefits of a traditional covered call, but you're utilizing much less capital up front to place the trade. So instead of buying 100 shares of stock outright, which can cost quite a bit. So say you've got $100 stock, and 100 shares of a $100 stock are going to cost you $10,000, right? Well, that's a pretty big investment up front. Now, if you want to control the same 100 shares, you can utilize what's called a LEAPS option, which is a long-term equity anticipation security. Fancy name for a deep in the money call. So you buy this at around a year out. You can go a year or a little bit longer, but it's a long-term option. And the cost for that is typically about 20% of the amount of buying the 100 shares of stock. So instead of paying $10,000 on a $100 stock, you'd basically be paying around $2,000, so much less than buying the 100 shares of stock. And just like a traditional covered call, we're going to sell a short call against it monthly to collect that monthly income. And by doing this, we're placing the trade, collecting that monthly income for much less than we would with a standard traditional covered call. So this is the main difference. The 100 shares can be very expensive. Both strategies generate income from selling the calls, and the max risk of a poor man's covered call is much less than the traditional covered call way. So the max risk is the amount that you pay for the LEAPS option minus your collecting monthly premium. So it's for the LEAPS option, if you're at $2,000, that's your max risk. Versus for the stock, we talked about 100 shares at $100, that's $10,000. If that stock drops 40%, you lose $4,000, right? Well, the max you can lose on the poor man's covered call would be $2,000. So being capital efficient, that's the main benefit of the poor man's covered call. So how does the poor man's covered call work, and how do you set it up? Well, first you buy a long-term LEAPS option about a year out, so 365 days to expiration, and it's in the money. And then secondly, the second step is you sell a shorter term call option against it in about 30 to 45 days to expiration. And we're going to jump in and I'm going to show you live on the trading platform here in a minute. But I just want to explain it first. Now, if the short call expires worthless, in other words, if the price moves up and it stays below that short call price, you keep the entire amount of premium that you collected for that month, whether it be $200 or $300. And you do this month after month, generating monthly income. And visually think of your LEAPS option as the synthetic stock position. So just like owning 100 shares of stock. Now, the monthly or quarterly income is that leg is your monthly income generator month after month. So it allows you to participate in the upside of a stock. So it's a bullish strategy while generating that monthly income against it and then rolling up and out month after month, that short call. So how do you set up the poor man's covered call step by step? All right, number one step, choose the right stock. Pick a stock you're bullish on for the long term and that has liquid options. So blue chips names like Apple, Microsoft, I'm going to show you one coming up here that is primed for the poor man's covered call. So stay tuned and comment down below if you've got a stock that you think is great for the poor man's covered call as well. But you want to work with a liquid stock since they have tight spreads and many strike prices. Step number two, select your leaps call. Buy a deep in the money leaps call option with a long expiration, typically 6 to 9. I like to go at least 9 months up to about 12 or even 18 months if it doesn't cost that much more. And I look for a call with a delta of 0.65 or higher since it will behave similarly to owning the stock, but at a much lower cost. Now, for example, if the stock is trading at 160, you might buy a 140 strike leaps call expiring a year from now. Now, step number three, you pick the short call to sell. Sell a shorter term out of the money call option, typically 30 to 45 days out, with a strike price above the current stock price to generate income. This option caps your upside but generates premium income you keep if it expires worthless. So as long as the stock price stays below that short call strike price, then you keep the entire amount that you collect up front. Now, step number four, how income is generated and managed. Well, the premium you collect from selling the near-term call creates consistent income. If the short call expires worthless, you repeat the process by selling another call in the next monthly expiration cycle, continually collecting premium month after month. Now, if the stock price rises above the short strike price, you can roll that call higher, or if it's close to expiration, what I like to do is close it and roll out and up to the next month. So let's look at a hypothetical example. Stock XYZ is trading at $160. So you buy the leaps call, the 140 strike expiring in 12 months, and you pay $25 premium. So what's $25? One option contract controls 100 shares of stock. So that's really $25 times 100 shares. It's $2,500. Now, you sell a call, the 170 strike expiring 1 month from now. So you sell that short call and you collect a $3 premium. So what is that? $3 times 100 shares, it's $300 per month. And your net capital outlay is the $2,200 for the leaps, your net capital outlay is $2,200. It's the $2,500 for the leaps option, and then the $300 that you collect, you subtract that from the $2,500 to come up with the $2,200. It's much less than buying 100 shares for the stock price of 160 times 100. That's $16,000. So you generate monthly income by selling your calls and still participate in the stock price appreciation between 140 and 170. So you want it to move up and to that 170 or above, and you are a winner. What are the risks and adjustments that you should make when managing the poor man's covered call? All right, what happens if the stock drops? Even though the poor man's covered call reduces upfront capital compared to buying shares, it still carries risk if the underlying stock price falls significantly. The long leaps call you hold will lose value as the stock drops, and your max loss is limited to the net premium spent to establish the position. So that's nice. It's better than owning the 100 shares. Unlike owning stock, you won't lose as much capital up front, but heavy declines can still erode your investment. Now, when do you roll the short call? Rolling the short call means closing the current short call position before expiration and selling a new, usually later expiring call. So I roll from the current month out at around 15 days to expiration out to the next monthly option chain near 45 days to expiration. So you typically roll if the stock price is near or above the short call to avoid assignment or to capture additional premium. Rolling out can manage risk or keep the income flowing if the stock moves against you. Active management of the short call is critical to balancing income with the risk. Now, managing the long leaps option. How do you do that? Well, the long leaps acts like your stock ownership and requires monitoring for time decay and changes in implied volatility. So as expiration approaches, the leaps loses time value faster. So you may choose to sell and buy a new leaps to maintain the position. Now, if the stock falls too much, cutting your losses on the leaps early can protect capital. I'm not usually doing that. I'll usually buy more because I'm only doing this strategy in stocks that I know are going to go up over time and they're undervalued right now. So managing the long call position alongside with rolling the short calls is the key to maintaining a balanced capital efficient strategy. And when do I close my leaps option? If I start out about a year, so 365 days to expiration. If I'm still long and bullish and it hasn't reached my target price yet, I'll maintain that leaps option until I get down to around the 6-month range. That's when time decay starts to really happen a lot faster. So at that point, I'll wait for an up day and then I'll close out the leaps option and roll it out closer to a year. Now let's jump into the live poor man's covered call trade that I'm putting on right now today. All right, guys, the stock that I'm putting a poor man's covered call on today is Salesforce, ticker symbol CRM. Now, if we look on Yahoo Finance right now, we can see what they do. Salesforce provides customer relationship management, CRM software. So it's a software as a solution business, SaaS business. So they connect companies and customers together worldwide. The company offers Agentforce, an agentic layer of the Salesforce platform. So it's utilizing the cloud and AI to manage relationships with customers. So almost every business utilizes, if they've got a Salesforce, they've got some sort of CRM system. So Oracle has SAP, that's one. I've used them all, but Salesforce to me is by far the best, and they're growing like crazy. You'll see it in this video. So let's look at a couple other pages here on just Yahoo Finance. So this is all free data, but they're trading at 244 right now. Look at the 1-year target that the analysts have on, 334. So that's a huge, almost a 30% upside from where it is right now. And if we look at the 1-year chart, you can see it was up as high as 371. So it was just up there in December, so within a year. And it can get right back up there. The software as a service companies right now are a little undervalued. So they've got the two things that I like about Salesforce and these type of businesses in general, it's recurring revenue. So they've got their customer bases. They're going to pay month after month. So they know what their revenue is going to be quarter after quarter, and they just keep beating the numbers. So I like the recurring revenue model, and then also the 90% margins. Yeah, 90% margins. There's no real huge overhead, right? You're selling software. So that's beautiful. Now, if we go to the statistics page, you can see the PE right now is at 21, the price to earnings. So typically it trades at much higher, 30 and above. And for a company with this growth, that's a great deal right now. The PEG ratio, so that's taking the PE and comparing it to the growth. The PEG ratio is 1.28. So that's great. Anything under 2 is fantastic. Now, if we look at the analysis page, we can see they beat earnings the last 3 quarters. They normally beat earnings every quarter. The revenue growth, consistent revenue growth, and earnings growth. That's what we're looking for. And the strong buy and buy ratings by analysts. And You can see the earnings history consistently increasing, earnings per share trend increasing, and the growth estimates. It's a 12% grower next year, 11% this year, so extremely consistent. All right, let's jump on the, this is a Tasty Trade trading platform, and it's the one that I use. I love for options and for my trading account. So check out the link below. There's some benefits if you go through my link, but it's super intuitive platform and easy to work with. It's fast too on placing the trades. So if we punch in CRM and then we go to this little tab right here, I don't know what that's called, but you can see the income statement, revenue and net income, and you can see increasing quarterly and annually. Now with the balance sheet as well, move this over here, you can see the assets and the liabilities. So strong position. Ratios, gross margin, wow, it's down to 77%. It was at 90% a little while ago, so I don't know how that changed so quick. But super profitable. 77% is fantastic. So if we look at the chart, again, we showed you this chart, but it's down right now. So the 50-day is below the 200, but there's a lot of support down here. So to me, this is a great play for the poor man's covered call and a leaps option because there's such huge upside up to this 366, and analysts have the target at that, and you've seen the numbers with the growth as well. So great play right now for the poor man's covered call. So if you go to the positions that I have on, you can see I put this one on this morning. I bought the September leaps, and then I sold the 260 call against it, and we're trading at 244. So let me show you how that's done. We're going to take out the weekly options. I like to trade the regular monthly options that expire the third Friday of every month. So what I'm going to do, I go out 365 days right here. We're going to open up the September 2026. This is where we're going to place our leaps option. We just click on it and it opens up. Now you can see I bought the 240 for around $40. I'm not sure exactly what I paid for it this morning. Let's see. I paid, well, here I'm down $32 on it today. But yeah, I bought the 240. Oh, this doesn't tell me exactly what I paid. But all right. So 240 is going to be around $4,000. $40 times 100 shares. Now, if we were to, let's act like we're placing a new one right now. $40. We'll click on that. We're paying $4,000. So that's really $4,000. But we're paying that instead of 245 times 100 shares, that's $24,500, and we're paying $4,000, so much, much less. So if we go to the curve mode, and then this is what I love about the Tasty Trade platform. You can see as long as the stock price increases, we increase in the value as well. If we get up to that 350 price, target, my target price over the next year is 350. It's 100 points higher. If we get to 350, this that I'm paying $4,000 for, P&L at expiration is $68.84. So almost $7,000, almost double what it is. But we're not only collecting that appreciation on the leaps, we're collecting monthly income against it. So let me show you. But I just wanted to show you that curve mode. That's what I love about this platform. One of the things, one of many. So we're going to close this up now that we've got the 4,000 on. And you can see the max loss, $39.90. So it's what we pay. So unlike this 245, if we were to buy 100 shares of stock, the $24,500, that could move down. Not that it's going to go to zero. Salesforce isn't going to go out of business anytime soon. That's my take. But 24,500, if it decreases 30-40% or there's a big hit, then we lose a lot more by owning the shares versus the max loss of $4,000. So we're going to close this up. Now let's go to the I'm going to go out to November. And since we're already at 29 days, I'm going to go out 64. A little bit. I normally like to go around 45 days, so it's kind of a trick, kind of in between, but I've already got some October positions on. So I'm going to go out to November, and then I sold the 260 call. So that's the 36 delta. So that's got you subtract that from 1, and that's a 64% chance probability of it expiring below that 260 price before the 64 days to expiration. But we collect $730, more than $500, but we're a little bit further out than 1 month. So that brought down the price. Let me take that off. So the price was $4,000, right? Now, when we click on this, it's going to decrease the cost by $700. In other words, this $700 by selling a call against it, you get that deposited in your account right away, right when you hit review and send and place the trade. So that's going to bring down the cost. It's going to cap the top at 260, but we're going to profit anywhere from the 240 call all the way up to the 260. So it's going to cap our upside, but that's okay. The odds are in our favor. So we're going to click on this, and it's going to bring down the price by $700. Boom, $32.70. So if we go to curve mode, well, it's messed up because I've got a lot of other positions on, but that will cap our profits by doing that on the leaps option. But again, I roll this month after month, and if we can collect $500, $700 a month, the cost that we're paying up front, the $32.63, that's going to be paid off in less than 6 months. So this is a way that you can control 100 shares of stock for free in 6 months. And that's what I love about the Poor Man's Covered Calls. So we hit review and send and place the trade. Quick recap, the Poor Man's Covered Call lets you generate consistent monthly income month after month while still allowing the capital appreciation on the upside and profits there as well. So you can basically control 100 shares of stock outright in less than 6 months. So remember to like and subscribe. Let me know in the comments below what you're trading with the Poor Man's Covered Call, if you're using it or another strategy, and what stocks you like right now. Do you like Salesforce? Let me know. Any questions, I answer every one. Thanks for watching. Check out the free options workshop as well and the paid course. And if you liked this video, watch this next one.